In this video I will show you some slides about United States global macro situation and they are quite fresh and if you are watching it in August 2023, I think it is absolutely okay. I will try to add my comments and it will be positive or negative. It is related to positive for stocks. Here you can see dry powder and definitely companies have a lot of money or dry powder. In housing bubble you can see it was maybe $700 billion, now it is $2 trillion. So I think it is definitely positive for stocks because we have a lot of money for buybacks. Corporate bond yield versus Fed funds rate. Right now it is absolutely useless to buy corporate bonds because they yield only 0.12 higher than Fed funds rate, and that is why it can be some sort of a prediction for a crisis. You can see it here in 2000s, then 06, 07, and then crash in 08, 09. The same situation before COVID, and right now we have the same. And it means that smart money definitely thinks that everything will be not really good in economics. Definitely it is a negative for stocks. Here you can see chart produce more but earn less. Interesting gap between GDP and GDI. And I it is income and it is strange because we produce more and earn less. It is quite funny, and the main idea that they will come closer again, and maybe it will be under zero line, and it is definitely negative for the stock market. Long and variable lags, and it is quite hard chart from Bloomberg, but the main idea is that Fed sensitive inflation still near highs, and it means that we're just getting some downside from Fed rate hikes, and maybe we will see some sort of a deflation in the future, and I think it is not really good on the short term for stocks, but on the long run definitely it is a plus, because if we wouldn't see inflation, Fed will lower rates and everything will be okay. Manufacturing PMI, and I really like that Russia on the top positions right now, like in India, and you can see that United States below 50, and it is not really good. And definitely we have some outsiders like Czech Republic, Germany, Austria, and Eurozone. It is a little bit negative for the United States stocks. Dallas Fed Manufacturing Index, you can see a lot of things here, like paid for raw materials, but if we will check this level of general business activity, it is minus 20, and again this chart talk for himself. Drawdown in 2020, and it is really interesting. Definitely it is a negative for the stocks. It is a service sector index, and again you can see this drawdown in 2008 and this one. It is not absolutely bad numbers, but if we will see a bigger dip, it will be scary a little bit. By the way, if you like the form of this video, please push the like button and write something in the comment section, because it is quite hard to do these videos, because I have to prepare some slides. Market News International Chicago Business Barometer, and again, as the same levels were only in 2008, 2020, and now. Definitely negative for the stocks. Manufacturing PMI, we already saw it. Also, we have the same PMI, but from ISM, and they're talking that it is not actually super bad, 46.4. They have overall economy break-even line, 48.7. It is not really far away from 50. I don't think that it is a huge problem on the long run, but definitely, yeah, it is not good. Logistics Managers Index, and it is on a lower lows. Maybe you hear something about yellow, they are actually feel it for a bankruptcy. Definitely, it is pure negative for the stocks, because if you have problems in logistics, it covers the whole economy. Credit contraction. Here you can see a yellow, it is a loan demand, and now we have the same level of demand like in 2009, because actually companies don't need loans on these rates. It is quite interesting. Definitely, it is a negative for the stock market, because if you're not getting loans, you can spend a huge amount of money. Tighter credit conditions would weigh on small businesses, which account for most job openings. Here you can see that 76.4% it is smaller companies with 1 to 249 workers, and you have to understand that small businesses can cut their costs and lay off workers really fast. And actually, we need to watch only on one parameter, and I will show you what it is in the future. Definitely watch this video until the end. But again, if we will see a lot of initial jobless clients, you have to think about closing all of your stock market positions in the United States, because definitely we will see some drawdown. Business new orders, price index, and employment, and everything on the levels before the Corona crisis, and definitely it is not a positive term, because right now we don't have a Corona crisis. United States job openings falls to lowest since 2029. It can be a good sign or a bad sign, because maybe they just hire people. Here you can see United States employment cost index quarter over quarter, and you can see that employment costs actually going down from 1.4 then to 1.2, and now it is 1.0, and definitely it is a good sign, because now you can hire more people, and your costs of doing business will go down, because now people will cost you less money. Layoffs rate by industry sector, and now it is a little bit better than in February of 2020. It is a little positive for the stock market, and United States employment cost index, it is a positive too. Here you can see a slide where actually we have new jobs, and 201,000 were in leisure and hospitality. It is not really high GDP adding value sector. Zillow rent index versus US core CPI rent component, and Zillow I think can really get faster numbers, and this rent component will definitely go down, and it is definitely positive for the stock market, because it wouldn't need to control and still use this 5.25 Fed funds rate. But on the other side, we have this prediction from Zillow again that in June 2024, in 11 months, the average home price will increase for 6.3%. If you think about it, it is definitely negative because you can just get money from the stock market where you don't think super comfortable and buy a house and rent it out, and you will generate 6% plus some rent money. Definitely it is negative for the stock market. Number of student loan borrowers by age group, and I hope you already know that this moratorium for payments for student loans will end in October, and 45 million people will spend around $200 just on these loans. And definitely it is negative for the stock market because they will spend money not on products and services. And maybe October will be a start for a new market crash. I saw the same chart from different sources, and some sources saying that people actually spend all their savings, and people don't have actually more money, and that is a negative for the stock market. Household savings reserve among total, and you can see this green, it is over 60% total, and people have savings from 0 to 3 months. For 60% of the United States population, it is mind-blowing. A record stock versus bonds optimism. People actually buying stocks right now, and I think we have opposite mechanics here, that it will be some sort of a highs on the stock market and lows for the bonds. Cumulative flows from global investors into DM and EM funds, and you can see that people actually putting money to passive and not active funds. Some strange data sector position measures. Once again, funds putting money to technology, telecom, and consumer staples. A median monthly flow into equity mutual funds and ETFs as a percent of total assets under management, and it is just for fun because it is just a negative 0.1% in June and August, and a little bit in October and December. People just getting money to have some fun and spend them on a vacation. First quarter of 2023 central bank demand is the highest first half total on a record, and the talking green one, it is a demand for gold. Here you can see tons, and definitely it is interesting, but I am not investing in gold, and plus we will see another slide in the future. Cash and liquid assets in $1 billion, and actually you can see that right now we have a little bit more money in mutual funds, but it is not a really huge amount of money to stop market from crash. Funds actually covering their shorts, and I think they're covering it not because they know something. I think just market going versus them, and they're just covering not to have a lot of losses. Insider transaction ratio, and if we are higher than 20, it is a bearish market, and now we have ratio 33. It is not really a good market. JP Morgan publishing that their clients buying a long range treasury bonds, and now we have some sort of a highs, and it is not good for bonds because I think we don't have more people to buy bonds, and it is a little bit sad, sad for me because I have bonds, and I think that TLT will go back to 120, and maybe in 1 or 2 years. Definitely it is a safe bet. Surging demand for calls, and you can see that now we have highs for 2.5 years, and definitely we have opposite logic here. I think regular people are buying calls, and regular people will always lose on this market. 12 months change in debit balances in customer securities margin accounts. As this slide, it's quite not interesting because you can see that actually people getting a leverage for their money to buy securities, and it is not really positive for the stock market, because if they already get like $300 billion, definitely they can just take more $300 million, because it is not realistic, because this chart from 1998, it is just not possible. If we will combine all years in one, you will see that we already saw something like this, and if we will see a little drawdown, maybe for 10% on S&P 500, it will be absolutely normal year. And we're coming for interesting one, S&P 500 quarterly earning per share, percent year over year. I think it is a definitely huge sign, but you can just remember that if earning per share come to negative zone, maybe somewhere here, it always predicts the recession, or it is already a recession, because this is how it works. Like people see really bad earnings, and they just pass it away and buying houses or bonds. That is why we have a bigger drawdown on the market. United States public debt outstanding in $1 trillion. Here you can see 2023 it is around $30 trillion, and in 2033 it will be $50 trillion. I really don't know who will actually buy for $5.2 billion every day for the next 10 years. I think it is not realistically, and definitely we will see huge problems in the next 5 to 10 years, but I hope we wouldn't see it in the next several years. Plus, I will tell you that for a huge crisis, definitely you need some sort of a bubble, and I think this one actually can count like a bubble. Just remember my words. Corporate America is rethinking cash use, and you can see this capex increase and buybacks slow down. Maybe it is a good sign, because capex actually provide more value for GDP growth. United States and local income tax receipts check burst in 2020, housing bubble in 2008, and now we have the same rates. Definitely we will see some sort of a recession in the future. Definitely it is negative for the stock market. Current expenditures, interest payment, Bureau of Economic Analysis. I think right now it is over $1 trillion per year, and with income around $4 and $2 trillion. Right now, the United States government spending 20% of their income to cover debt, and it is absolutely not healthy. Real imports of goods and services and it is not really a nice chart, because if we will see a drawdown like this in 2000, then like this in 2009, and like this on the COVID crisis. Now we have the same pattern, and definitely it is again a sign for a crisis. Real GDP growth quarter-over-quarter in percent, and we have this slowdown until 2024 or middle of 2024. New listed homes from realtor.com, but it is not really interesting. It can not mean anything, because now we have a really high rate, and maybe that is why people just not list their houses. Home owner vacancy rate, and there is no empty houses with owner, and it is definitely a good sign for real estate business. Cumulative job gains, and this slide about that actually job gains slowing down, and in reality we have 13% less job gains. Continued claims, and we have like plus 300,000 unemployed people, and it is not really cool. Unemployment rate, it is really awesome parameter again, but it is not worked in 2009. But again, we have it worked in April of 2000, and then we have the same parameters right now, and it is absolutely normal that crisis comes from low numbers of unemployment. Change in annual pay, and the amount of growth actually slowed down, and it is a positive sign. Once a res construction declines 8 to 10%, a recession begins. And here you can see residential construction payroll drawdowns and recession. And actually it worked in 1990, then it worked in 2000, 2008, in COVID crisis. And now we have this sign, but I think now it can be proved. Global money market funds assets in $1 trillion, and you can see that money market funds actually feeling really nice with $8.1 trillion, and this money can actually really fast go to the stock market. Net flows in a stock market, and we don't actually see any flows, and this is negative for the stock market. And actually, if we will check what hedge funds do, you will see that they're investing in Europe and Asia. It is quite strange. United States retail flows rolling 20-day average, and again it is not a flow if it is in a negative zone. And you can see that retail push of TLT, and actually people are buying TLT, and I suggest you to just cover your stocks and buy TLT, and don't think about that strange market. Call options are really in a high demand, and I think it is not good for ordinary people. If you didn't see these slides from Fidelity, you can just recheck them. They are definitely interesting. United States coming to recession, and China already in a recession, like a Eurozone and the United Kingdom, but it is quite old slide from May 2023. Maybe now everybody in a recession. And now we will talk about earnings per share by S&P 500, and actually this chart predicted it 3 times. In tech bubble, we get information that earnings per share declined from their highs, and we get it with minus 25% on S&P 500, and after the signal, the stock market crashed for 25% more. And the second time it predicted on 2009, we get a signal on a minus 7% zone, and then the market crashed for 48%. You can check it on macro trends on this link, and if we will see a drawdown to 130 to 140 bucks, it will be a signal again. Here you can see a PMI as a sign, and again, if we are coming to this 45 mark, in the tech bubble it predicted on the minus 13 from the highs, and then the stock market made minus 30% more, and then in 2009 we get signal actually to sell the whole market on a minus 25% mark, and after it the market crashed for minus 40%. Definitely we don't have sign right now, and we're waiting just not a good PMI report, and they are doing it every first day of the month. It is definitely good because it is month to month. And the last one, it will be a spike in initial jobless claims. You can just monitor it on a lot of sites, and again, when it growing for maybe 50% or something like this, you can call it a signal, and definitely sell your stocks and maybe get a short position. I think it will really work well, because it is just a basics of how it works, because companies firing people, they don't have money to buy stuff, then companies showing us really not good reports, and we can see it in earning per share, and that is why we have a cascade of sell-off, because people just selling everything to pay for their collateral. So I spent 40 minutes on this video. Please push the like button. I hope you enjoyed it. Bye bye.